Hello, everyone. My name is Sanif. Welcome. I am the Senior Dry Bulk Freight Analyst at Kpler. Welcome to Kpler Quarterly Dry Bulk Webinar, where we discuss trends that shape the supply and demand of dry bulk commodity and freight market. Let me give you a brief introduction about Kpler. Kpler is a market intelligence company that provides clarity on seaborne commodity flows. We interpret these flows and provide analytical insights so that we can build a clearer understanding and prediction of the market. Today, we will discuss key trends that will shape the market for the second half of 2025. Two experts will lead our discussion. Alexis Elenda, our Senior Lead Analyst for Dry Bulk Insights, and Isan Banu, our Lead Agricultural Analyst. Please ask questions. You will be able to see a Q&A box at the bottom of your screen. So use it to submit your questions, and we will answer this at the end of the presentation. We will also record this webinar so you can replay it. So without further ado, I'll pass this on to Alexis. Hi, Alexis.
Hi, Hanif. Thank you very much, and thank you to everyone who's joined us today. I can see that, just a few more people trickling in, but I think we'll kick things off. So what we're going to look at here in today's webinar is some of the seaborne dry bulk commodities and the freight outlook, particularly focusing on the second half of 2025. I mean, a lot of the chartering activity for June is going to be done now, so really turning to the second half of the year. And rather than just do a kind of a general overview, we've decided to pick up on some three key trends for the second half of this year that we think you should really be aware of, you should be looking at and including as part of your market decision making and as part of your analysis. So the first one we're going to look at, iron ore trade growth to lift Capesize demand. So where are we? If we take a quick look at where we are on the Capesize market, the start of this year. So earnings have started softer. So this first chart here on the left shows the time charter averages as assessed by the Baltic Exchange. I'm sure most of you are very familiar with these. This is a seasonal chart, so each line represents 1 year. And we can see this dark line here for 2025 has been tracking below the same period last year. So 2024, we've been down. So the 5 TCs have averaged just under sort of $14,000 a day in the year to date. And that compares with over 23,200 in the first 5 months of last year. And we've seen a similar trend when it comes to the iron ore spot voyage rates. So these are the cost of moving iron ore from load port to discharge port, the C3, Tubarão Qingdao, Brazil to China, the C5 West Australia to China. And so the C3's averaged about $19.50 in the year to date, down from sort of $25.61 in the first 5 months of last year. Similarly, C5 about $7.70 in the year to date, again down from over $10 in the first 5 months of last year. So everything's been lower. Why is this? What's happening in the market? So a big part of last year, if you remember, we had stronger Brazilian iron ore exports in the first quarter of January of 2024 because of a lack of seasonal rains. So this year we've had a more typical rainfall pattern and we've seen lower exports. So Brazilian iron ore exports over January to April down by just over 11 million tons year on year. Then in Australia, we've had cyclone-related disruption to the export facilities, Port Hedland, Dampier, and so on in northwest Australia, and Brazilian exports Australian iron ore exports over the first 4 months of the year been down by just under 8 million tons year on year. And that Australian decline actually comes despite the ramp up at Mineral Resources Onslow project, which added about 4.6 million tons to Australian exports since the start of this year. So without the ramp up at Onslow, we would see an even steeper decline in Australian exports. And it's important to note that those declines there, so Capesize demand, falling on those major iron ore routes, actually exceeds the growth we've seen in West African bauxite exports over the same period. So January to April this year, there was growth of just under 16 million tons in Guinean bauxite exports. So even though, yes, Guinean bauxite's still been growing strongly, that added demand has been countered by the drop-off in what's happening out of Australia and Brazil. And I think the final thing I just want to add on that is that, if we look at on the right here, these iron ore spot voyage rates, so these consist of the time charter rates, the bunker prices, and also other ancillary costs. And lower bunker prices are also weighing on these spot voyage rates. So the drop in the oil price as a consequence of uncertainty around the trade war has actually brought down bunker costs. So something like the Singapore 380 price was down 14% year on year in April. And that is then weighing on these spot voyage rates as well. So adding to that downward pressure on the Capesize market. So however, having said that, we expect shipments, iron ore shipments to pick up in the second half of the year. This is why we're seeing this as, despite the weak start, we're still fairly bullish on the Capesize market. But first, kind of before we go to why, we have to really kind of tackle another elephant in the room, which is, China's steel sector. This is slowing. Everyone agrees it's slowing, but then how can we still be bullish on iron ore and on Capesize demand? Well, what does a slowing Chinese steel sector look like? So on the chart on the left here, we have crude steel production in China. So we got the very recently just got the April data. So Chinese crude steel production came in at just over 86 million tons in April, close to flat year on year. And that was slightly lower, really, than a lot of analysts had expected, a bit of a drop off from the very strong March total. January to April, crude steel production in China up by, very slightly, about 0.4% year on year. Nevertheless, despite this, we are expecting a steep slowdown in crude steel production in China in the second half of the year. You can see on the chart on the left, the dark blue bars are the realized, the light blue is our forecast. For all the reasons that we've all seen widely discussed. The Chinese government is committed to bringing steel production down, the pressure on steel exports, the effects of the trade war. And so our projection is for a drop of about 2.75% year on year in annual crude steel production in China. But that requires, because of the small level of growth in the first 4 months of the year, requires quite a steep drop in the second half of the year. Now you'll see in May, we have a little bit of an upturn. This is not to do with any rebound, really. It's because May has one more day in it than April. So you get an extra couple of million tons of production for the month. So the pattern we're expecting is something more similar to 2023, where we saw a sort of a steep drop off in steel production in the second half of the year. In 2024, around sort of October, November time, we saw some stimulus supporting steel production. And also the changing of rebar standards, which required a bit of destocking and then sort of steel production in order to rebuild those stocks at traders. So there was a bit of an artificial boost to crude steel production in the back end of 2024. However, despite this decline in steel production, we do not expect a similar drop in iron ore imports. Chinese iron ore imports will be firm through the second half of 2025. Our annual projection is for, nevertheless, a drop of about 35 million tons year on year in 2025 to about just 1.24 billion tons. However, this is primarily due to a very weak 1Q. So if we look at the chart on the right, Chinese iron ore imports, you've got the dark blue line for 2025. It's a seasonal chart. Each line represents 1 year. And you see this very steep drop in February. This was to do with the factors we talked about on the previous slide. So, a return to more typical seasonal rainfall patterns in Brazil, slowing exports there year on year, and also disruption in Australia. This is a kind of a one-off, not representative of market factors. And you can see there was a quick rebound in March, good performance in April, and then continuing through the remainder of the year. Our expectation is that, where the iron ore demand, the loss in iron ore demand due to lower steel production will fall will be primarily on the domestic ore. Also some of the smaller exporters, particularly India, we'll see on the next slide. We also see there's a little bit of a scope for some restocking of iron ore because, iron ore port stocks are down by about 10% from their peak in the fourth quarter of 2024. So having tackled that one, let's see, what does this actually mean for seaborne trade? So we expect, seasonal iron ore imports, iron ore imports will increase in the second half of this year. That's not a surprise. They normally do increase in the second half of the year versus the first, but by how much? So Australia, we're expecting just under 37 million tons more iron ore exports. A lot of that is down to recovery from disruption in the first quarter. There will be, obviously, the production will be, and output will be higher. And also there's the ongoing ramp up at Onslow and one or two other projects as well. Brazil, seasonal increase in shipments, very typical, add about 30 million tons to the seaborne exports. Canada, seasonal supply increases again. So you've got the Baffin Land shipments coming online in the second half of the year, adding to volumes there. But then we look elsewhere in the market. India, I mentioned India is a place where we expect iron ore to be displaced from. This is generally slightly lower quality, higher cost iron ore. We're expecting, already seen some steep drops in volumes in the first few months of this year. So we're expecting a further drop of about 8 million tons in exports on the half on half. Peru, this is very much a consequence of the shiploader outage. I'm sure some of you have seen that story. We're not expecting the shiploader exports to restart until about October. So that accounts for the drop in production there. Then we look elsewhere, South Africa, Sweden, West Africa, pretty much flat year on year. In West Africa, we have had the announcement from Rio that they are going to plan to do a shipment out of Simandou before the end of the year. However, it remains our base case that there won't be any kind of serious commercial shipping of iron ore from there until the second half of next year. Although it is worth noting there are other companies that are investing in more iron ore exports out of West Africa. So some of ArcelorMittal's projects and also some iron ore out of Mauritania as well. So I've said already that there's always a ramp up in iron ore exports in the second half of the year. So how does this ramp up compare to previous years? So if we look at 2022, we had an extra 58 million tons. 2023, 99 million tons. 2024, because of that strong start to the year, particularly due to the lack of seasonal rains in Brazil, only up 30 million tons. Well, this year we're expecting an additional 64 million tons. So that's equivalent to maybe close to 350 standard Capesize stems. But what I would also say is, yes, there's a jump. But also, if we look at the total, that should be pushing towards, a new high for Capesize for iron ore trade in the second half of the year, kind of above 870 million tons. And a lot of that, obviously will be iron ore trade going on the Capesizes. Australia, Brazil, Canada, that's where the growth there, that is going to be Capesize. The loss of Indian trade, that's going to be mainly smaller vessels. You get some Supras and Panamaxes doing that as well, maybe a few Capes, but not to the same extent. So what does that mean for Capesize earnings? Well, I think I looked at the FFAs at the end of the day yesterday. They're trading around about $19,000 a day, I think, for the second half of the year. I said that's too low. I think we're looking at probably, steady 21 and above $1,000 a day for the second half of the year. I think it could be other factors as well could support earnings, which we'll come to slightly later in the webinar. So let's go into the second key thing I want to look at, which is, in contrast to Capes, we're going to see pressure on sub-Capesize sectors are going to persist and potentially even more mounting towards the end of the year. So what is happening here? Well, I'm sure it's no surprise for many of you to learn that, sub-Capesize markets have been under pressure. So Panamax earnings we have on this chart here on the left, seasonal view, each line represents 1 year. Again, significantly underperforming 2024. So in the year to date, they've averaged, the TC averages, just under $10,400 a day, compared with, 15,800 odd in January to May of last year. We also look at at Supramaxes, particularly I've highlighted here on the chart on the right, the Pacific coal routes. So this is actually the new Supramax indices from the Baltic. So this actually are Ultramax vessels, but they call it Supramax Index. So that's why I've kept the Supramax title. You can see the 11 TCs here averaging just under $11,000 a day in the year to date, compared with over 16 in the same period last year. And we've had the steep seasonal drop. This happens, more or less every year. Seasonal drop around Chinese New Year, lower demand, and a rebound, but we're still well off where we were in 2024. And the other interesting thing I'd like to highlight is the kind of the difference between the S8, so your sort of Indonesia, East Coast India coal routes, and your S10, your China and Indonesia coal trade routes, which normally, historically, they've tracked each other quite closely. But actually here we've got India coming above China, and I would say is certainly a factor, and that has been the lower demand for imported coal out of China, which we'll come to on the next slide. So what has been driving this demand, this weakness in the market? So what we have here is coal trade we expect will continue to decline in the second half of this year, particularly on thermal coal, and it'll be Panamaxes and Ultramaxes, Supramaxes that will bear the brunt of this. So in the chart on the left here, we have Indonesian coal exports by vessel type. So you've got the Capesize in the dark at the bottom, the mid blue, the Panamaxes, light blue, Supras, Ultras, and so on. This Panamax includes Capesizes as well. And then you've got your sort of your smaller handies as well. And what I really want to highlight is that Indonesian coal exports in the first quarter were down by just over 12 million tons year on year. And it was sort of the Panamax, Capesize tonnage, and Supramaxes that bore the brunt of this. Now, actually, Supramaxes saw a bit of a larger fall because the cheapness of the Panamaxes made them more competitive at the start of this year. So we saw Panamaxes gaining market share, even though overall volumes were dropping. Now, if we look ahead here, these yellow bars are our forecasts for the remainder of this year. So the second quarter, obviously, we're kind of midway through that now. We're expecting a drop of about 29, 30 million tons in Indonesian coal exports. This is including lignite. And then, so another 26 million tons drop in the third quarter, and then another sort of 28, 29 million tons drop year on year in the fourth quarter. So even though we're seeing a seasonal increase in trade, volumes will still be lower year on year. And it is particularly Panamaxes, Supramaxes, the demand that will suffer as a consequence. Now, what is happening? Why is there this drop? Well, the chart on the right here shows our projected changes in 2025 seaborne thermal coal imports. So this is for the full year annual total. And I mean, the big thing to note here is China. So we're expecting a drop of more than 60 million tons in seaborne thermal coal imports into China this year. And this is a combination of improved domestic supply in terms of mining output. Some stockpiles are pretty good. And also the switch from El Nino to La Nina. So the summer temperatures, should not be as high this year as they were last year. Hydropower, much better availability in the country as well this year. And then also drops in India, where they've got better domestic supply and also very high coal stockpiles. Structural changes, Japan and Korea weighing on thermal coal demand. And even in Southeast Asia, so, Vietnam being a big driver of imported coal demand. We're not expecting the same rate of growth this year, and a lot of that is down to the seasonal switch from El Nino to La Nina, temperatures not being as high, and also improved general supply situation across the region. So that is weighing on the demand of Panamax and Supramaxes. But the other factor as well hitting these smaller vessels is changes in the grain trade. Now, I think Ishan will probably be able to cover some of this in some more detail as well in the Q&A. But let's just say for the start off with our assumptions here are based on current policies. We know with the trade war, US-China relations, things could change. So let's have a look. We're in the seasonal surge for Brazilian soybean exports. 2Q exports pick up. And over the sort of the first 4 months of this year, Brazilian soybean exports up slightly year on year, just over 38 million tons. Our current export projections for the calendar year 2025 is growth of just over 11 million tons. And this implies strong demand sort of from 2Q shipments into the third quarter for grain carrying vessels loading out of Brazil, because the soybeans, large volumes there, will probably push the corn shipments later. And that will, support demand over a longer period. Now, this is being driven by Chinese buying. The Chinese are buying, Brazilian beans instead of US soybeans. So they're supporting demand now. However, this is going to come at the expense of US soybean exports in the fourth quarter. So even if the US and China make a deal on, it is probably going to be too late to see big volumes of US soybeans going to China this year, because they will already have bought the Brazilian beans. So on the right-hand chart here, now this could change if policies change, but this is our current forecast. So this is based on the marketing year, so September to August. You can see the typical pattern for US soybean exports, big peak in the fourth quarter before tailing off to a very, very low level through the second and third quarter, actually where we are now. So this blue line is our current expectation for US soybean exports. So the projection in terms of, volumes for the fourth quarter, we expect exports of just under 10 million tons, which would be a drop of about 17.5 million tons year on year. So, that's equivalent to losing something in the region of, 360 stems on a bulk carrier. So that's a lot of loss in terms of grain cargoes. And for the 2025-26 market year, so we're expecting a drop of about 18 million tons in US soybean exports. So what we've had is demand brought early in the year because of Brazilian surge, and actually in the back end, the fourth quarter, we're going to see a lot less demand for grain carrying bulkers, because there won't be that strong US soybean trade. So that coming on top of what we were talking about before, the weaker outlook on the coal, particularly for the sort of Panamaxes, Capesizes, and the geared vessels, means that we're quite bearish on the second half of the year for these smaller vessels. Okay, so that's kind of point number two. And point two, the third story we really want to talk about was talking about fleet inefficiencies and dry bulk carriers. So the one story that you should all really be on top of this year when it comes to the dry bulk fleet and dry bulk carrier supply is that the number of bulkers off the market is set to increase this year. And this is because vessels built over 2010 to 2012 are coming up for their sort of 5-year special surveys, and this will tighten vessel supply, and again, particularly in the Capesize fleet. So the chart on the left here shows the dry bulk carrier fleet by year of build. So it's not the fleet on those years, it's the vessels built during that year. And you can see 2010 to 2012, there was a big spike in deliveries following sort of boom time in Chinese dry bulk imports, a lot of ordering. So you've got about 3,200 vessels here of about 271 million deadweight tons. It's equivalent to about 26-27% the dry bulk fleet. These are coming up for their 5-year surveys. And we look at the chart on the right here. We pull the numbers for the proportion of the fleet due for the special surveys by percentage of counter vessels, not deadweight tons count. So you can see here, Capesize fleet, 18% due for special survey this year. Panamaxes, sort of Capesizes, 15%. And then Handys and Supras, about 17%, in the 16-17% over the same period. We then look at 2026, again, Capesizes, more, about 25% almost of the Capesize fleet due for a survey, and then small ones round about 20-21% of the Panamaxes, Supramaxes, then slightly less for the Handysizes. So two things here to note. Because a vessel is due for survey in 2026, doesn't necessarily mean it has to go then. It could go a bit earlier. The ideal time to book your survey, would be in the 1Q if you can get the yard space, because that's when the market is weakest, demand is lowest. So, it's best time to go. So you may see some of these Capesizes here due for 2026 might start heading towards the yards in the back end of the very end of 2025 in order to position themselves for the first quarter. How long does it take for a survey? It can vary, but you can look at slightly over a month in order to get, positioning to go to yards, in yards, out yards, get everything sorted. So it's not an insignificant time to be off the market. And again, fitting with our thesis of being more bullish on the Capesizes versus sub-Capesize sectors, it's the Capesize sector here, 2025, 2026, where the greatest proportion of the fleet in number of vessels will be going off the market. Now, just a couple of other stories, I think, to keep an eye out on the supply side, which we want to track, because also this fits our thesis with being slightly more bearish on the smaller sizes, is looking at supply side risks in port congestion and rerouting. So with the large volumes of grains coming out of Brazil, we always highlight the risk of port congestion. But actually, if we look at the chart here on the right, the number of vessels waiting to load grains in Brazil, we're really not seeing anything special at the moment. You can see this number is really just kind of, tracking the volumes from 2022. This number here was when we had a record corn crop following on from a big soybean harvest. We saw big congestion. This is, back a couple of years ago, but since then there's been a lot of investment in Brazilian port infrastructure. So at the moment, even though we're getting these very large volumes, we're not seeing the same level of port congestion we have in previous years. So, one of the stories about, Brazilian grain supporting the market is it ties up vessels. We're not seeing that at the moment. So one to watch, but at the moment, no big support for the market coming out of Brazil. And the other thing is, look, we've all been, following the stories about the Suez Canal, Panama Canal. I would say this is one to watch now as a potentially bearish one for the market, because we look at what's happening with Panama. This one has kind of trade volumes, in terms of percentage of total trade through the canal, returning to kind of typical levels. Suez, not yet. However, we've had this US Houthi truce that might see, a bit more of trade going through the region. And I think it's really important to remember with these congestion and this inefficiencies that they tighten up the market on the way up. So as congestion gets severe or disruption, it supports earnings. But as they ease, as they disappear, they then bring earnings down again by adding to supply. So this is one that could potentially be quite bearish. And again, it's not a lot of Capesize trade that goes through the Suez Canal region. This is mainly sub-Capesize vessels. So again, supporting our case that if this comes back even sort of halfway towards previous levels, being bearish on the sub-Capesize sectors. Okay, so let's just pull together some of the key pointers of the market. So we've seen that the Capesizes, the market has started 2025 lower, with lower bunker prices weighing on spot voyage rates, but we expect this to firm. Iron ore chartering is going to boost demand in the second half of this year, and we've got more supply coming online through new projects as well as the usual seasonal upturn. And where we're losing some volumes from India, that's not hitting the Capesizes in the same way as the additional demand that's coming in from the likes of Australia. However, if we turn and look at China and India importing less thermal coal, Pacific coal chartering activity has fallen year on year at the start of this year, and we expect these declines to persist through 2025. China will take less coal. India will take less coal. The monsoon season there is expected to be longer, wetter, cooler this year. There will not be the same demand for imported coal. Demand for grain carrying bulkers will be lower in the fourth quarter this year because of a lack of US-China soybean trade. After buying all these Brazilian beans in the second quarter, even if there is a US-China trade deal, they don't need to buy the same volumes of US beans they have in the past. Really important to note on the supply side, the big story this year is, a sharp increase in vessels due for special surveys is due to tighten supply, not just this year, but over 2026, 2027. And I put supply side risks and port congestion and trade choke points. Supply side risks both on the kind of the positive for earnings, but also on negative potentially risks for earnings. If we do get easing or congestion underperforms expectations, that could weigh on the market. Again, negative, for the kind of the sub-Capesize sectors. And really, this chart on the right here is just kind of encapsulates kind of like why we have these kind of diverging views on the different markets. So this is the annual change in seaborne trade. So not absolute volumes, but the annual expected change. So for iron ore, our projections, we're looking at growth of just over 20 million tons in seaborne trade this year. And then we look at bauxite, growth of probably just under 30 million tons a year. So this is driving, Capesize demand. We're, if we then look at thermal coal, we're expecting, a big drop of about 76, 77 million tons in seaborne trade this year. And then also met coal, a bit of a drop there, probably just under 10 million tons. A lot of that's down to, the Anglo-American projects that have had to be, halted in Eastern Australia. And then grains, this soybean story, we're expecting a drop of, something in the region of, 27, 28 million tons under current circumstances. So you've got the positives in the Capesize sector here, a lot of the negatives here in terms of lack of trade growth in the sub-Capesize sectors. So that really kind of encapsulates why we have a kind of a divergent view on the two markets. And remember as well, the special surveys, the vessels leaving the market, that's hitting the Capesizes to a greater extent in terms of proportion of the fleet in 25 and 26. Okay, I think I'll hand you back to Hanif now, and we've got time for some Q&A. Thank you, Hanif. Please send your questions into the box below.
Yep, thanks, Alexis. We've got loads of questions, but I think I'll lead with questions regarding greens and oilseed first, and I hope Ihsan can join us in a bit. So, yep, we've got one question now. So regarding China buying more soybeans from Brazil, what will happen to the US soybeans now that the Chinese tariffs on US goods are lower? Ihsan?
Thanks, Hanif. So I don't disagree with what Alexis said. It's more of the same. Despite much lower tariffs, they're lower than 140%, but they're still 23%. So that just kills the trade. But secondly, more importantly, China doesn't need the US soybeans this year just because of the fundamentals in the grains markets. The additional supply from Brazil is more than sufficient, and more than sufficient to allow China to tide through the Q4 period and wait until Brazil, the next crop from Brazil, which comes online by the end of January 2026. So even if there were no tariffs, the US-China soybean trade would be very questionable, would be very low this year.
Thanks, Ihsan. Thanks you so much. Then we've got also a question regarding Russia. So will a peace deal with Russia increase any wheat supplies from the Black Sea?
So a peace deal with, no, that's a good one. So the markets have been selling wheat based on chances of peace with Russia, but a peace deal will actually reduce trade out of the Black Sea and will make it more uniform through the year. So last year, Russia exported record quantities in Q3 and Q4 in certain months. No grain trade has really been impacted after the initial issues at the beginning of the war. Grain trade continues out of the Black Sea, and last year Russia exported record quantities in certain months despite having a low crop because of uncertainty, because of volatility and illiquidity in the ruble, in the currency markets, as well as uncertainty about future pricing. So if things get better, if there is peace, it will bring certainty to the grains and the forex markets, which will allow Russia to uniformly export its wheat through the year rather than rushing to the market at harvest. So if there is peace, in fact, it's contrary. Flows out of the Black Sea will be more uniform through the year and lower year on year in Q3.
Thanks so much, Ihsan. Then we've also just coming back to the questions of soybeans. I know we've covered on the congestion part at Brazilian soybean because of the increased demand. So just want to reframe back, because we are expecting increased demand at Brazilian port because of increased demand to purchase soybeans. I'm not sure Alexis or Isan, both of you can choose to answer this. Do we think congestion is going to be slightly lower than last year, and how will this impact supply and then freight rates, especially for the sub-Capesize?
Let me start from the commodity side. We usually compare it with 2023 when we had a large export program of soybeans, corn, sugar, and soybean meal out of Brazil. This year, soybeans soybean export program will be strong, and but will be strong and similar to 2023. But the corn export program should not be as aggressive, because back then it was due to strong demand from China, which we don't expect this year. On the infrastructure part, I think Alexis can answer.
Yeah, thanks, Ishan. I mean, obviously, completely agree with what you're saying there. I think on terms of the shipping and the infrastructure, on the chart on my presentation, I'll just jump back to it very quickly. Look, we can see at the moment, despite strong volumes of soybeans, we're not seeing the same level of congestion, as in terms of when we had the big surge a couple of years back, and Brazil has made investments in its port infrastructure. They are shipping from more ports, and they've got more capacity. So I think it's perfectly reasonable when there is always the opportunity of a trucker strike or something like that causing delays in Brazil. But at the moment, port congestion is within the kind of the normal bounds. We're not seeing a big surge. I don't see any indication really that's happening at the present time. So this is why I've kind of highlighted it as a potential downside risk for earnings, because there was perhaps an expectation that with big volumes of Brazilian soybeans going, that we'd see lots of port congestion. It just hasn't materialized.
Thanks so much, Isan and Alexis. If we stay on the same chart, because I've got a question as well on the transits at either Suez or the Panama Canal. So we've mentioned that most of the dry bulk that transits by the Suez Canal are not Capesizes. So a lot of these are the sub-Capesizes, ranging from grains and others. So the question is that regarding the recent brokered ceasefire between the US and also the Houthi brokered by Oman, do you think ship owners will be keen to return to transiting at the canal?
I mean, I think really a lot of things in shipping, it comes down to economics. At the moment, there's a couple of things. So at the moment, vessels still go through the Red Sea, Suez Canal. They are still going through. They're going through fine with no problems. I think, in terms of having peace treaties, it doesn't remove risk, but it reduces it. So I suspect what we'll see is a situation where you get a few more vessels, and as more and more vessels, if more and more vessels go through without incident, we'll see that they start to, we start to see a pickup in volumes there. The only thing I would say against that is that the drop off in bunker prices does make it cheaper than it was last year, for example, to go around the Cape. So that has, although it would still be more expensive than going through the canal, the additional costs are not as great. So you've got to balance off your insurance premiums and the risk there against the additional fuel and higher costs. So people have to redo their calculations. I suspect it will be a case of, as I said, as we had previously with the Black Sea, there will be a few shipments going, and as more shipments go with that incident, there'll be increasing level of confidence in taking the route.
Thanks so much. Thank you so much. I think we've got more questions now, but I think these questions are moving on to the Pacific side right now. So maybe we'll pick the coal question. So given the performance of coal trade this year, do you think the coal trade has actually peaked last year? And is the underperformance of this coal trade right now, is it a supply issue or is it a demand issue?
So I think you've got a couple of things going there. So seaborne coal trade will be lower this year than it was last year, as you saw in our kind of our forecast at the end. Big factors in this is improved supply in China and India. You know, that's not going to go away, and also lower demand because we've switched from El Nino to La Nina. Now, I would never call that, like, you know, coal trade is completely over, because, you know, we could get a weather event similar to, you know, in 2023, 2024, where we had a lot of hot weather driving demand. But certainly, I think coal trade at the moment really does appear to be in a sort of a sort of a structural decline, not because perhaps China and India are you know, committed to completely phasing out coal. They're still burning plenty of it, but they're focusing on their domestic production rather than their imports. Obviously, if we look at the Atlantic, yeah, complete structural decline. You know, Drummond and Cerrejón cutting production. Europe just not buying coal. You know, that market is you know, completely you know, on the kind of structural downward path. I think what would be interesting to see is in a couple of years' time, when we switch back from La Nina to El Nino, to see what happens with coal trade there. Because whether we do get another push in demand, I'm inclined to say that we might get a bit of a, you know, a bit of a further bump at that point. So that'd be probably 2 or 3 years' time. But certainly for the next couple of years, I'm quite bearish on the coal trade outlook. That's thermal coal, met coal as well. I think it's just been supply side disruption in Australia for the Anglo mines, and also the increasing Mongolian trade overland into China, just displacing that seaborne met coal.
Yep, thank you so much. Let's stick with the coal topic, because we've got another question here. Because that commodity is a major demand driver in the Pacific, do you think the slowdown in seaborne import will affect the, you know, bit supply in the region?
Well, I think you know, the Pacific is the driver of you know, is the big driver of demand in the, you know, for the dry bulk market in terms of imports. Yes, you know, we look at that chart that I had of the Supramax earnings, you know, the weakness in sort of your S8, your S10, your coal trade route. So absolutely, you know, we're seeing less demand for the smaller bulkers. That coal's not going to go elsewhere to the Atlantic. So it is really just you know, it's lost tons coming out of the market. Particularly, I think Indonesia is always positioned as the swing supplier, but also you know, Australia as well. I think we're not going to have lots of additional volumes coming out of there in terms of thermal coal. Met coal's down. So you know, as I said, pretty bearish on coal.
Yep. Another question. Now we're moving on to the steel sector, especially for the Chinese. Because Chinese is a major steel exporter, will the slowdown in their production affect other shipping demand?
Yeah, so Chinese steel exports have been massive in recent, you know, last year, 2024, and also, you know, in recent months as well. We've seen very strong volumes, a lot of protests, you know, about the people, you know, countries such as Vietnam, such as India, introducing tariff barriers and sort of anti-dumping regulation to try and stop that. Now, I mean, we've seen different numbers. I think Baowu came out with a number saying it's like 15 million tons of steel production we lost by a drop in Chinese steel exports this year. So we, you know, we've been saying for a while that steel exports in China have to come down. I think you know, that will be the case. You know, steel production, you know, is slowing. A part of that will go into lower exports. I think what you could see, which I think could be an interesting shift, is a shift from maybe exporting of finished products as more tariff barriers are put up against those, to maybe a switch to exporting more semis, which will then go for further onward processing in other countries. I mean, the classic place where a lot of this stuff is reported to go is Vietnam. But again, Vietnam is building its own domestic steel industry as well. So, you know, I think there is some pushback there as well in sort of Vietnam, also Thailand, to the Chinese steel exports. So I don't expect it to be sustained at the current high levels for the long term. It will come down. And that will obviously hit demand for the smaller bulkers, because that's you know, that's a geared bulker trade, really.
Yeah, and because you've also mentioned one of the first reactor to a slowdown in China's sector will be the Indian iron ore, will be, you know, on the smaller sizes, especially Supramaxes. Now we've got a question. Now I think this one is a farther trade, and it aligns with Capesizes. So bauxite, our favorite question. Do you think the ramp up in Simandu could support growth for bauxite? Because we're also hearing that alumina price is collapsing, and those also other issues in other exporters of bauxite. So what do you think basically is the how do you think bauxite trade will support Capesizes?
Look, I mean, so we expect growth in bauxite trade this year. If I go to our chart at the end, so the really important thing to remember when we talk about bauxite and aluminium is that the cost of bauxite is a very tiny proportion of the end cost of the aluminium produced. The big cost for if you're producing aluminium is electricity power. So there's plenty of bauxite produced. The alumina production in China has been hitting record levels. We've seen the alumina price in China has basically collapsed. And that's down to, you've got improved hydro availability in the country, has enabled those to really ramp up. In terms of what we're looking at out of Guinea, we expect further strong volumes through the remainder of this year. We are going into the rainy season in Guinea, so that's kind of May to October. So there will be a seasonal slowdown, but we see that further, there is going to be further growth. There were a couple of stories that came out sort of the start of this week, end of last week, about some more licensing problems. We know EGA have had, their exports halted from Guinea. I think, there will potentially be, some sort of regulatory problems. You do in some of these jurisdictions do get regulatory issues. I think the number one thing to remember is that the priority of the Guinean government is going to be to maintain the money coming in. So to keep up the flow of dollars coming in from the sale of bauxite, and then from the sale of iron ore sort of from next year. So, and Guinean bauxite is, Chinese companies have invested a lot into setting up these big operations there. They're going to keep moving it. We're still fairly positive on the Guinean bauxite export story, and obviously positive there on Capesize demand.
Thank you so much. There's another one question. I think this is regarding the US port fee. How has the US port fee, the current version of the US port fee, frame the dry bulk market?
Yeah, so I think the US port fees, I think the question there refers to, the proposed fees on Chinese vessels going into US ports. Now I didn't mention that because I don't see it as a bigger factor in the current market. I don't know, Hanif, if you want to you did a lot of research into it. Do you want to just give the viewers a minute or so of what you found?
Yeah, sure. Just for context, we published reports on this already. So when that first happened, we anticipated much larger impact, but then the blue softened after the second revision. I do encourage you to visit our Kpler terminal, and if you don't have access to it, just please send us a message, and I'm sure we can set you up with this. But basically, from our latest research, only 1.5% of US dry bulk import voyages will be impacted by the latest port structure. So that's a major change from the previous version of the port fee, which would have otherwise impacted or elevated shipping costs equally on both exports and import side. But the latest revision have introduced annexes, and these annexes come with exclusions, criteria, which has led us to our analysis that 1.5% only of dry bulk imports will be impacted. I think I'll leave it to you to interpret the reports, because it's very lengthy and it's open to interpretation. But it is our educated analysis is that mainly two annexes will govern the dry bulk trade at least. So we've got two annexes. The first being Annex 1. So this one targets ships that is operated by Chinese entity or owned by any Chinese linked entity as well. It will be assessed agnostic to the voyage distance, the vessel size, and regardless of any trade direction. So meaning still import and export will still be affected. But in the case of no Chinese entities are involved operating the ship, or the owner of the ship is not a Chinese entity, then Annex 2 becomes the rule. So Annex 2 targets Chinese-built vessels, But even before this Annex 2 incur fee to that vessel, two criteria have got to be met. First, being the size of the vessel. The vessel has got to be at least 80,000 deadweight tonnage, deadweight ton, excuse me. And it must have sailed over 2,000 nautical miles to reach the US ports. If either of these conditions aren't met, then that voyage will be exempt from fee. And last one, there's also an exclusion which spare US dry bulk exports on Chinese-built tonnage entirely. And again, if you would like a list of comprehensive analysis, please visit our terminal and let us know if you need access to it. Just want to frame finally on the US port fee. The revision really softens the blow, but it does not eliminate the risk totally. I think because you guys can agree or disagree with me, given the current climate we're in, I don't think it will be a surprise that the scope of this US port fee could evolve further in the future.
Thank you, Hanif. Okay, look, I think we're coming near to the end of the time there, so I think we will wrap it up there. Thank you everyone for attending. If you want a copy of the slides, please get in touch. There will be a box at the end of when you sign off from the webinar. If you have any further questions, please don't hesitate to email us, get in touch, or if you have any other questions about our research. Otherwise, thank you very much and enjoy the rest of your day. Goodbye.